Amajuri from HCSE2X, and I'm creating a project called the Robo-Advisor for Portfolio Management. I'm doing this with collaboration from Supriya Singh from CSE Evening Batch, and our faculty guides are Mr. Kunal Gupta and Mr. Harimohan Pandey. Now, the Robo-Advisor for Portfolio Management is an application that's created in R with the primary purpose of algorithmic trading. Often you have everyone who has a retirement account probably has their money in the stock market. Most people are just not aware of this, and the primary reason that my coworker and I have wanted to venture out into this field is to increase financial inclusivity, so that more people have access to the sophisticated tools that stockbrokers, financial advisors, and other investors use to generate profits. Now, a little bit of background on why this is so crucial is that 55% of those who enter the stock market lose more than half of their initial capital within the first year. Only 4% of those who enter the stock market are able to generate a profit of 50% or more on their initial capital investment. Now, what's the difference between Group 1 and Group B? The primary difference is the insights that they have, the information that they're using to make decisions about when to buy, when to sell, and in what volumes. This app does primarily that. Now, a little bit about the architecture of the app. You have a control tower. Let me explain what a control tower is. It's an area from where a user can access all of their financial instruments and the data associated with each one. Let's say I show interest in the stock for Microsoft. Now, what I would do is search for Microsoft in the control tower, and what would happen then would be that a really beautiful interactive PDF would be generated that would have all the statistical data related to that particular stock. Thereafter, I can decide whether or not I'm interested in making an investment in Microsoft. Next, that was just a little bit of an introduction. Now, the efficient market hypothesis. It's a hypothesis that states that it's impossible to beat the market, that the market always makes up for any discrepancies in prices. Let's say, for example, when Steve Ballmer decided to resign from Microsoft, the stock took a hit. Why? Because investors lost confidence in the company. Next, as soon as Satya Nadella joined, the stock price went back up. Now, this is basically that the valuation of the company is always reflected in the stock market, so one needs to be very, very, very wise about the decisions that they make in the financial market if they're serious about making money. This tool is used for asset management. There are two major advantages of this tool. The first being that it provides a free method for a user to invest in the stock market or any other market, commodities market. Let's say they want to invest in gold futures or oil futures. They can do this through the control tower and the Shiny app. Now, this is an advantage because otherwise they would have had to go to an investment advisor, a portfolio manager, and these people, they're known to charge fees anywhere between 10 to 20% of the money that you're investing. That's a huge chunk of your money going to someone who's making the decisions for you. Now you can decide for yourself. You'll have the same insights as them using the control tower. And the second biggest advantage of algorithmic trading. Algorithmic trading is the primary background used in this application. Algorithmic trading allows trades to be performed at superhuman speeds. Before a human can decide when to buy what and in what quantity, it's too late. Even a second can make a big difference in profits. So this application has the advantage of the computer doing everything for you at superhuman speeds. Next, another great advantage of this application is that a software or a computer is not emotional. Often when investors are trying to make an investment, they are swayed by their emotions. Let's say everyone starts to sell a certain stock, then the person gets nervous and they sell it too. Often humans, we tend to lose our rationality when we're nervous. The advantage that a computer provides you is that it's not biased or emotional. Now, this application is a black box trading application. What does this mean? Well, the control tower serves the purpose of allowing one to decide which instruments they're interested in. So I gather data for, the tool gathers data for me for, let's say, 100 different commodities. Now, thereafter, I decide which ones I'm interested in trading. Thereafter, the computer, it's a black box system from thereafter. The computer decides when to make a trade, when to, and in what volume, whether to buy or sell, and how much to buy or sell. This portfolio management tool also provides you with every possible service that a traditional investment advisor would. Say dividend reinvesting. This is when companies they pay a certain amount to shareholders based on the profits that they generated. So it allows you to reinvest that money back into the stock market. It also generates compliance reports. It does portfolio rebalancing, and when it also manages the tax on each transaction. Next, here are the tools we've used in this application. The primary tool used here is R. R is used for programming all the different trading algorithms. We'll get into each trading algorithm a little bit later. MS Excel, you'd ask why use something that's so simple. The main advantage of this application is simplicity. We want to be able to attract as many users as we can. If we were to use something more complicated, our user base would be limited to computer science or tech people. Using MS Excel, it provides a lot of simplicity, and the application can be used by just any person, grandparents, young people who have no formal education in technology. Additionally, VBA is used for Excel VBA is used for creating functions within Excel. SQL is also used for data management, but this is on the back end. XML is used to create some buttons. Now, the control tower that I was talking about all along, that is created using knitr and latex. BERT is the basic Excel R toolkit. It provides you a lot of different ways to connect Excel and R. Fiddler is a package for loading financial data. It's called the Financial Data Loader. We'll get into that in a little bit more detail now. Fiddler and QuantMod, these are the two add-ins that we've used. Fiddler makes the financial data downloading process very simple. The data we're using here is downloaded from Yahoo Finance. So each time the control tower wants to generate a PDF file for a particular instrument, it fetches data from Yahoo Finance. Fiddler also gives you the advantage of using Bloomberg Terminal, various different data sources. However, Yahoo Finance is open source. It's free, so this was an efficient way to implement this without increasing the budget of the project. Now, the QuantMod package, it's in R, and it allows the user to perform various different quantitative trades, such as developing the quantitative strategy, testing, and deploying all of this. It's one of the most essential aspects of this application. Other packages have also been used, performance analytics, and a few other packages, but these are the two primary ones. Now, a little bit about how the data is managed. So we maintain a database of price files. If I express interest in, say, 5 different commodities, 3 stocks, Yahoo, Microsoft, and Bloomberg. These are the 3 stocks I'm interested in, and the other 2 instruments are, say, gold futures and oil futures. Now, each day, you're going to have to update the data, right? Because you want to see the PDF files in real time. As soon as you click it, each time a new PDF file must be generated. So that's the updatedata.r. Now, when you first express interest in a particular instrument, you're going to have to update this file called listofinstruments.r. Like the name says, it contains a list of all the instruments that you have, and the historical data. That is the data up until now. The reason you have update data.r is to get current data. Now we've automated this process called update daily price using a batch file called update daily prices.bat. The template reports, the ones that are generated using knitter and latex, those are the PDFs. They contain a lot of the statistical data that one would need in order to make a sound investment decision. It has trading strategies performance report. So it gives you basic performance charts for particular time periods, say daily, monthly, yearly, or 6 monthly or quarterly, whatever is relevant. It gives you a lot of trading statistics as to how much of a particular commodity was bought and sold in a day, and also the recent performance figures. All of this wouldn't be possible without the framework Shiny. It's an R framework, and it really has made the development process of this application quite simple, where Shiny takes care of HTML, CSS, and JavaScript for you. So as a quantitative finance software developer, you don't have to worry about the UI. Shiny takes care of all of that for you, and you can focus on getting real work done. Now the Shiny app, it contains, the control tower, and then the next step is the black box trading. So this Shiny app is where the system generates a signal. The signal contains whether to buy or to sell, and also in what volume to buy or sell which commodity. The Shiny app gives you access to every single trading strategy from one single point, and it applies to all the instruments that you're trading. It also gives you tools that allow easier comparison, and you can select the time period. This comparison part is done using Tableau. Tableau is a fairly new analysis software. Now the scope of this application is that it's going to be it's going to be a user application. We're going to make it available open source, and what I see as the big contribution to society is that now a lot of people that earlier didn't have access to financial markets, they're going to be included in financial markets. Well, they're going to have access to something that they didn't earlier, where they had to spend a lot of money to get access to an investment advisor. Using this app isn't going to be the case anymore. Now, coming to the paper that's going to be written on this, we go into the motivation and scope. The motivation primarily has been to increase financial inclusivity, to bring access to, a Robo-Advisor can have access to, your data, and it really makes the process a lot cheaper, where you can make investments without having to worry about hefty fees. Then the application areas are where we want to beat the efficient market hypothesis. Like I said, most people lose their money. This application gives you the insights that you need to make informed decisions so that you keep your money, you grow your money, and you do it worry-free. Now, the objective is to make sound financial investments, leaving financial inclusivity and everything aside. The application would be no good if it wasn't generating profits. So that is the primary objective of the application, is to generate profits for the user. Now, this project wouldn't be possible without the collaboration of two people, myself and Supriya Singh. Next, we also took a lot of help from our faculty guides, Mr. Hariman Pandey and Mr. Kunal Gupta. The project has been organized the following way. We have chapter 1, which is the introduction, the part that we're in now. Next is the literature review. We've read certain research papers. We've looked at market studies, and also tried using certain proprietary trading tools. This part discusses that. The next is the experimental design, or the setup, the actual coding of the application. Next, we have the results and the analysis. So here, the main result or the main way to ascertain the efficacy of the application is using the profit factor, the PF. It's a ratio between the number of trades that generate profits and the number of trades that generate losses. We always want this to be much, much greater than 1, but usually a ratio of 1.5, 1.8, these are good ratios which show that you're generating more profits than losses. You're making money. When you go below 0, that's just you're in the danger zone. The limitations. Now, one primary limitation of this application is that each time you make a trade, there is a fee associated with the trade, the brokerage fee. Now, as much as we would like to make this completely free, this is something we can't get rid of. So the user will have to keep this in mind that for each transaction there is a fee that the stock market charges you for buying or selling. And then the references part goes into the various different places that we've referred to get help with programming the application. Coming to the literature review part, we talk about trading algorithms, what they are. They're an automated way of deciding when to buy or sell. Next up, we have the history. Trading algorithms have been around for a long time, but it's only in the 2000s that they became really popular, really mainstream. While earlier you had the problem where it was limited to sell-side firms, hedge funds, and brokerages, but now even buy-side firms are using trading algorithms. Well, sell-side and buy-side just means companies that normally make money through selling, and the others are through buying, making the market. Then up next we have understanding trading algorithms. I've explained this several times before, so I'm going to skip over this now. It's an automated black box mechanism for deciding where to buy or sell a commodity. Now this part, it's a large part. We go into a lot of depth about the various different trading algorithms used. Here I'll just name the ones we're using: the volume-weighted average price, the time-weighted average price, the POV, percentage of volume. There's just a lot of these in here. This is what we have so far. In the next presentation, we'll go into the methodology, and also we'll present as much of our application as we can.